The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Bravery or foolishness? The buy the dippers exploit that brutal sell-off that started the day. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. We're kicking you off to the closing bell right here in the U.S. A tremendous turnaround. This is a completely different board than you would have seen come 7 o'clock this morning. You have the S&P almost into neutral territory. Tech leading the way higher here, up by 0.7%. Is it a Trump put? Is it oversold? Did we just bounce around the 200-day moving average? That remains to be seen. The VIX still elevated, though, but selling in the back end. Those yields up 5 basis points, not providing the safety it did in the middle of the afternoon.
And we talk about that early morning trade. The chatter around trading desk was where was that line in the sand for markets. Bank of America had pegged it to the S&P's election day close of right around 57.83, a level the benchmark traded below early in the session, and that brought some dip buyers out. But Nomura's Charlie McElliott says getting the broad market rally fully back on track likely requires Trump to completely reverse course on trade policy, something the president said he's not doing. And here is that new policy. New 25% tariffs on all Mexican imports. New 25% tariffs on most Canadian ones. A doubling of levies on China to 20%. And a promise of 25% tariffs on steel and aluminum next week. Canada hitting back with phased levels on $107 billion of U.S. goods. China imposing tariffs of as high as 15% in Mexico, set to make an announcement this weekend. Tariff talk, as you can imagine, has been the talk of the town among the CEOs, CIOs, and the other executives who gathered today in Manhattan for the Bloomberg Invest conference.
We've not seen this level of tariff, at least in modern times.
I think these are going to adversely affect us with respect to inflation. They'll adversely affect us with respect to growth, adversely affect productivity.
The opinions on tariffs vary from they're incredibly inflationary to they are potentially contributing to a recession.
Gotta take that longer term approach. Hope or maybe expect at some point that they'll get to outcomes, markets will calm.
I think what you can't control is consumer confidence and corporate confidence. And I think that is what is falling off a cliff right now.
And as global markets assess the impact of what is now a global trade war, we do want to go out to Canada, where Jon Erlichman, BNN Bloomberg contributor, is on the ground in Toronto. We heard from the Prime Minister, the outgoing Prime Minister, Justin Trudeau, a little bit earlier, John, saying, quote, "This was a very dumb thing to do." What exactly is Canada's next move?
Well, the retaliatory tariffs that we very quickly saw, Romaine, from Canada was part of a plan the Canadian government has been working on for weeks now. Of course, nobody knew we would officially get to this moment, but they had been at the ready to reach this moment. There's basically a tiered approach from the federal government here on tariffs. There will be a larger amount of U.S. goods that are tariffed in about 3 weeks' time, bigger ticket items. And the government has been quite selective in which markets it's approaching for now. But it's a unique time. You mentioned the Prime Minister, who is about to step down, and a new Liberal Party leader will be selected. And at some point in the near future, we will likely see a federal election in this country. But to a certain extent, it has left a little bit of a power void, a power vacuum. To that point, you have seen not just federal government responses, but here in the province of Ontario, the newly re-elected Premier Doug Ford putting a tax on Ontario Power that's going to multiple states in the United States. So there is this approach at both the provincial and federal level to fight back. But at the end of the day, this is potentially economically damaging the entire situation, as you know, for Canada. And a lot of economists are very quickly predicting that if this goes on for a relatively long amount of period, it's quite easily going to create a recessionary environment in this country.
John, what kind of fiscal support did Prime Minister Justin Trudeau offer businesses that have to contend now with tariffs?
You know, it's an excellent question, Alex, because I think in the short term, what Bay Street and Wall Street are looking at is the monetary policy response. We do actually have a Bank of Canada interest rate decision upcoming. Increasingly, there's an expectation you'll see a rate cut at that meeting. Before this whole episode, Canada's economy, because of some rate cuts, was actually looking a little bit better. And now there are a number of firms that are anticipating we could see a number of cuts. TD thinks 4 rate cuts by the summer. But to your question about the fiscal supports, the Prime Minister, again, he's going to be stepping down from that role quite soon, talked about being at the ready with some supports for Canadians. But remember, the fiscal picture in this country is a challenged one as well. And there was a hope that if you do see a federal election and perhaps a new government that is more pro-business, that there ultimately would be an attempt to deal with the fiscal challenges in this country. So a lot of people we've been speaking to are saying when we do see Parliament get back to business, remember the Prime Minister had prorogued Parliament in part because of his challenges in staying in power. There would likely be some kind of meaningful fiscal support if there is no road ahead to resolving the tariff issue. But a lot of business leaders are hoping that there will be some targeted stimulus that will help industries to enable Canada to figure out a growth plan for the future. Just as a point of highlight on that, we spoke to the head of a major management company today that is looking for more action on the pro-business side for the country to take this moment and seize that opportunity to find a path forward.
Hey, John, really appreciate it. Thank you so much. Jon Erlichman, BNN Bloomberg contributor. Thank you. All right, let's turn now to Mexico. Mexican President Claudia Sheinbaum said she'll announce tariffs and other measures this Sunday in response to President Trump's tariffs. Joining us now to discuss is Carolina Milan, Bloomberg's Mexico bureau chief. A different approach than Canada, much more measured, a little more cautious. What can we expect?
Absolutely. And I think when we look at what we just heard from our colleagues in Canada, it's a really strikingly different approach. By kicking the announcement forward to Sunday, there's a couple of things that Sheinbaum's accomplishing. First of all, she's buying more time. We know that she's expected to speak with Donald Trump this week. She said it could be, it's likely going to be on Thursday. And that's probably going to be an opportunity for the president to reiterate all that Mexico has done so far, from sending troops to the northern border to apprehending and then sending to the U.S. several criminals accused of being linked with drug violence, and initiating talks on trade. So that seems like it could be a key that could lead to an outcome. Who knows, maybe on Sunday, depending on the conversation with Trump, the picture on tariffs may have changed completely. So definitely a different approach there.
Is there a sense here at all that Sheinbaum is keeping an eye on the market impact? Obviously, we've seen huge gyrations, Carolina, in the Mexican peso relative to the U.S. dollar.
Absolutely. And this is interesting because we had seen the peso be quite strong in the past few months when you compare it to Trump 1.0. Instead, these past few days, we've seen a lot more sensitivity. It weakened, but then it paired back gains. And what that's showing us is that investors seem to believe that there's a negotiated way out, that it's not going to be the full force of tariffs, the 25% that has been threatened, that will affect Mexico. So let's see what the next few days hold.
Carolina Milan out there in Mexico City, our bureau chief in Mexico. A closer look at markets here with the Mexican peso weakening for a 4th straight day versus the U.S. dollar. The loonie, the Canadian loonie, down for an 8th straight day. Let's keep the conversation going right now and bring in Mohamed El-Erian, Bloomberg opinion columnist, whose latest piece raises the warning flag that recession odds have become unsettlingly high, citing tariffs. He says, quote, the threat of a tit-for-tat tariff war has become much more of a reality this week, with the potential to disrupt global supply chains and stifle economic growth. El-Erian, of course, also president of Queen's College, Cambridge, and he joins us right now. Mohamed, I was just taking a look here at the economic forecast. We're coming off a relatively stellar year for the U.S. economy, almost 3% growth on a real basis in GDP. Expectations were for 2% plus in 2025. Does that have to be revised down?
I think so, Romaine, and thanks for having me. The median expectation is 2.3%. I suspect we're going to see a whole series of downward revisions in the next few weeks. I suspect those revisions will be from about 0.5 percentage point to as much as 1 percentage point. And if that happens, we're going to be discussing the risk of what's called stall speed, which means the economy isn't going fast enough to gain the sorts of traction that keeps us out of something worse.
So when we talk about what the economic conditions are going to be, Mohamed, are we talking about recession, or is this one of those sort of stagflation scenarios that a lot of economists have been warning about for the past few weeks?
So my own probability of recession has gone up from 10% at the beginning of the year to somewhere between 25 and 30%. So it's a risk scenario. It is not a baseline. The problem that everybody has, including the Federal Reserve, including market analysts, is that there's a whole range of outcomes right now, and not only growth outcomes, but inflation outcomes. So you've got to think in multidimensional ways. And it's this message of uncertainty that you heard all day long from the Bloomberg conference, that you hear in boardrooms, that you hear all around. Is there so many things moving right now that I'm afraid business will step back and say, you know what, let me wait and see how things evolve. And if that happens, then the economy slows.
So, Mohamed, the narrative couldn't be more clear. This is a risk. We're looking at a risk to growth. We're looking at a risk to inflation, et cetera. So what did you make of the reversal in the equity market today? Did that tell you something?
Yeah, what it told me is that investors have been conditioned for a very long time to buy on the dips. It's been a profitable strategy, and it's behaviorally now a bias in the market, if you like. And it takes a lot more than the sell-off we've seen to make investors go against that bias. It doesn't surprise me we've bounced. Mm-hmm. The question is going to be, where are we in a month's time?
Right. What happens after the bounce becomes a question. Mohamed, we also saw the probability of a rate cut now in May increase to over 50%. Do you think that's a done deal-ish?
Yeah, I mean, what's interesting is that the market now is pricing in 3 cuts. I think that's excessive. I think we're not only looking at lower growth, but as Romain said, we're looking at higher inflation. Very few people have paid attention, I know you have, to the prices paid component of the ISM manufacturing yesterday. That went up by 7 points. That's quite a move. We're seeing survey after survey point to expectations of higher inflation. I suspect at the end of the day, we're more likely to get 1 cut, if that. I don't think we're going to get the 3 cuts that the market is now pricing in.
It's interesting you say that. We just heard from John Williams on stage at Bloomberg Invest, kind of making it clear, at least from his perspective, he doesn't think the Fed needs to act right away. The idea that, yes, there is an inflationary risk, but as they have basically made clear to us, or at least Powell has, they want to wait to actually see that show up in the hard data, the actual economic effects. And I do sort of wonder, Mohamed, how long this takes to sort of work through the system. If there is a negative impact on the economy, like when do I start to see that actually show up in the hard data?
So you're going to see it show up relatively quickly. In fact, for some companies, you've already seen it show up. I think companies learned a big lesson in 21, 22. When they were surprised by the inflation, they didn't react quickly enough. Nowadays, they react much more quickly. Nowadays, both the willingness and ability to adjust prices is higher. So you've heard people talk about anticipatory price increases or preemptive price increases. So I think what you're going to get is a price level adjustment, but you're also going to get the second stage, which is the second round effect, happen more quickly. So it will be faster than most people expect, unless, and I want to stress, unless this economy slows down significantly. And if this economy slows down significantly, we have a much bigger problem on our hand.
It's kind of concerning, though, too, Mohamed, because we haven't really even gotten to the meat of this new administration's policies. And I'm talking mainly on the fiscal front. Obviously, we have a lot of things that need to work its way through Congress, and maybe we're going to get a little bit of a taste of that tonight during the president's address to Congress. But when we talk about some of the fiscal proposals that we know the president has said publicly he wants to pursue, those also have the potential to be a bit of a drag on the economy. And I am wondering if we are going to try to get some sort of balance here, whether it's either Congress pushing back or maybe the White House itself realizing that maybe we should kind of stagger some of these things.
Yeah, I think if you're sitting in the White House, you see the following. You see that you've succeeded in bringing energy prices down. Look what oil is trading. And that's a direct beneficial impact on real purchasing power of Americans. You will feel that your efforts on terms of public sector reform, DOGE, are going to pay off over the long term. You will feel that you've got deregulation coming that will spur private investment. And you would look at all this and say, you know what, the short-term disruptions are worth the long-term gains. So I don't think you're going to see massive reversals in the White House anytime soon. I think you're going to see conviction that these relatively small disruptions are part of getting to the better destination. The problem is this journey is a very challenging journey because you don't control sentiment. You don't control household sentiment and you don't control business sentiment. And if household and business sentiment continue to go down, then the task facing the administration will be much more difficult.
So in your best guess, is U.S. exceptionalism done or on pause?
I think U.S. exceptionalism is there, but it's subject to a bigger left tail than we have seen for quite a while.
Do you feel that if we get the more bullish sentiment parts of a Trump agenda, which comes in the form of deregulation and tax reform, if we get that within a certain time frame, could it really help reignite the U.S. exceptionalism?
I think it can. I think business is looking for that. But, you know, as a parent who used to take my child to Disneyland every year, and we miscalculate the amount of traffic, the destination isn't good if the journey can't be managed. They've got to manage the journey. And that's really now has become very important if they are to get to the destination.
All right, Mohamed, I have to leave it there. Always a great conversation. Mohamed El-Erian, president of Queens College, Cambridge, and a Bloomberg opinion columnist. And Alex, we should point out, stocks right now, as a group, now hitting session highs. We're talking about a 3 percentage point swing on the NASDAQ 100 from the peak to the trough to the peak, and 2% on the S&P.
It's really quite impressive. The NASDAQ did close below its 200-day moving average yesterday. So you wonder if there's some kind of technical bounce. It's also participating here. Yeah, we should point out, though, most of the sector is still in the red, and most of the dip buying is confined to that big cap tech space. What you're not seeing, some of those discretionary names get a bid at all. Target share is still lower. So too are Best Buy shares. This after we heard from both of those companies earlier today, with their earnings beat getting overshadowed by warnings of price hikes. We're going to talk about how the tariffs are striking anxiety among retailers. That's coming up next in our top calls. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start with Knight-Swift. Benchmark initiating coverage of the trucking company with a buy and a $63 target, with the analysts saying truckload rates and freight dynamics are finally starting to improve. That puts Knight-Swift in the perfect position to outperform its peers. The shares, though, down about 2% on the day. Next up, Roku. MoffettNathanson changing its tune on the streaming video service with an upgrade to neutral. The analyst says 2025 setting up to be a year full of earnings beats as advertising revenue grows. However, in the long term, he's still concerned about competition from other streaming services. Roku, though, getting a nice bid on the day, up 2%. And finally, a turbulent day for JetBlue. Deutsche Bank cutting its recommendation on the airline to hold, trimming its price target to $7. The analyst uncertain of when JetBlue can return to profitability. He also says macro conditions could weigh on demand for domestic air travel, which JetBlue is heavily exposed to. Those shares down 5%, and those are some of our top calls. We do want to stay in the world of earnings right now because this week is all about the retailers. Target out with results in from the fourth quarter, and they did show solid consumer turnout for the holiday season. But the real story is the look ahead, and that's how Target and its peers will respond to tariffs. They say price hikes are coming. Kate Mcshane, managing director at Goldman Sachs, joins us right now. She's got a buy rating on the shares. We heard this from Target. We heard this on Best Buy. I guess the question, Kate, if they do have the power to pass these prices on to consumers, do you think that is going to have a material effect on sales growth and on the bottom line?
Sure. So thank you for having me. I think, when it comes to price hikes, it is something that you will see pass through when it comes to tariffs. That's what we saw in 2018 and in 2019 when tariffs were first introduced and prices were passed through. And I think that's what we can expect to see again. What we are concerned about is just the elasticity response, right? How the consumer is going to respond to those price hikes. Will you see them pull back, depending on what prices go too. Obviously, there are going to be price increases across the board. So it's not necessarily like one retailer will look more expensive than another because everybody's prices are going up. Mm-hmm. But it will be the customer response of how they deal with those price increases. That's a little bit of an unknown right now.
So I guess my question then, Catie, if that is kind of an unknown, how much confidence do you have in the guidance that the company gave? Full year comp sales up 1.7% and adjusted EPS of 880 to 980. Are you confident in those numbers, or is it kind of too early to say?
Well, I think it's a very wide range guide that they gave today, and that's the key. It does incorporate quite a bit of this uncertainty that we're all facing today because of tariffs. And so it's a wide range. I think, again, you have to consider the macro, but you also have to consider the retailer. Mm-hmm. And Target is a great retailer. They have great merchandise. We heard a lot from them today at their analyst today about how they're introducing a lot more newness with new brands, new collaborations, and all the reasons why people have shopped at Target in the past should still be the reason why they shop at Target today. They're continuing to make it more convenient, which is a core tenet to why a consumer shops at a retailer that they shop. So there is the macro and there is the pricing environment, but then there's also the execution by the retailer.
Just to go to the macro for just another second here, you were mentioning back in 2018 and passing on those costs to customers, but that was not in an inflationary environment that we were just in. Does that change the ability for pass-through?
So it's interesting. I think, the setup this time around is that the consumer is relatively healthy. We have a discretionary cash flow model that we keep here at Goldman Sachs where we measure the cash flow of the consumer across income demographics. And we've observed that between the low employment, the wage growth, the fact that you have seen some alleviation of costs relative to last year points to solid discretionary cash flow for the consumer in 2025. So you're absolutely right that this is a consumer that probably is a little bit tired of higher prices. Prices, although have been easing, are still up relative to a few years ago. But really, from a consumer balance sheet standpoint, the consumer is relatively healthy.
You also cover Best Buy, and that stock just got taken out to the woodshed here. I mean, it's down currently the most since 2021. Is this an overreaction, or is this a legitimate move by investors to price in this uncertainty?
Sure. So Best Buy's quarter actually was much better than expected. The demand in the fourth quarter was positive, and that was the first positive quarter we've seen since 2021. So they actually had a great quarter. I think the stock reaction today is more with regards to the tariffs. They are more exposed than a lot of other retailers. 60% of their product is coming from China. They also have exposure into Mexico as well with their private brand. And so you will see price increases there as well. The debate, of course, is how much of technology and what you buy at Best Buy is discretionary. We are in a replacement cycle right now for things like computing and tablets. Those were categories that saw really strong growth during 2020. And now people are looking to replace those products 5 years later. And so there is a need there as we have more technology in our lives with school and with work that there will be a replacement cycle, and that could help with just the consumer stomaching some of those higher prices.
Given though some of the uncertainty around the tariffs, how long they could last, whether they would be expanded, are you concerned at all about inventory management, particularly with Target? We know they ran into some issues during the pandemic coming out of the pandemic with managing their inventory. Do you think that those supply chain management, if you will, at either of those companies has pretty much got it under control?
It seems like it. We haven't heard too much concern around the supply chain management piece of it. Certainly, there's going to be some changes in sourcing. I think if it hasn't already happened by some of these companies, they are looking to work with their vendors. They are looking to reduce their exposure to certain places where there are tariffs. But ultimately, I don't think we're going to see a lot of disruption in the supply chain.
All right, Kate, we really appreciate it. Thank you so much, Kate Mcshane over at Goldman Sachs there. But nonetheless, sort of factoring this in on a day-to-day price action, particularly as earnings roll out, is obviously going to be quite complicated, which is why you saw that big reaction for Best Buy today. Yeah, absolutely. Here, we don't want to belabor this point here, but stocks continue to power higher now. The S&P now poking into the green. The NASDAQ at session highs up 1%. Bitcoin has reversed its losses. The peso has erased its losses, Alex. The VIX, which was in the green, now in the red. And
what's happening?
What question that was percolating earlier was, is the White House sensitive to what's happening in the stock market?
Yeah.
So, but a lot can change in just a few hours. You have to wonder how much of it is technical and what happens after the bounce. That's also on the radar. All right, coming up, more market analysis on today's tit-for-tat tariff sell-off. Conversation with Mona Mahajan of Edward Jones is coming up next. This is The Close on Bloomberg.
Based on what we know today, given all the uncertainties around that, I do factor in some effects of tariffs now on inflation, on prices, because I think we will see some of those effects later this year.
Just about 3:30 here in New York. This is the countdown to the close. That person on the screen was not Alex Seal. It was New York Fed President John Williams speaking a little bit earlier at the Bloomberg Invest conference taking place right here in Manhattan. I'm Romaine Bostick.
And I'm Alex Steele. And taking a look at the uncertainty within the market, Harvey Schwartz was talking about this from KKR earlier, Carlyle. And he was saying that it's a tariff versus trade war. So tariffs can be a one-off inflationary impact, but a trade war could have prolonged inflationary impact. And that's what the market's trying to understand and decide between.
Yeah, I thought he really kind of encapsulated it at best, right? If this is something short term, then this dip buying that you're seeing today makes a lot of sense. If this is a prolonged tit-for-tat trade war, which potentially it could be, then it's sort of, as he said, buckle up.
But it's so interesting that right around the time we got comments from Canadian Prime Minister Justin Trudeau, that's when we wind up hitting the bottom in the market.
Yeah.
So go figure.
Absolutely. But I do kind of want to hear more from the economists in this, right? Because ultimately this is all about what's going to be the impact on the U.S. economy and ultimately on corporate fundamentals. And just as of yet, we don't really know the answer to that question.
No, so let's ask that question now to Andrew Levin, professor of economics over at Dartmouth College, previously on the Federal Reserve Board as well as an advisor. Andrew, it's great to get your perspective on this. Thank you for joining us. Back in 2018, the Fed had a roadmap and a model of how to deal with tariffs and looked at it as sort of a one-time effect, one-time price implication. Is that still the right model to be looking at tariffs today?
Well, I think the critical thing here is that the top two trading partners of the United States is Canada and Mexico, and it's in both directions. I think over the last 20 years, we've been used to, sort of the trade between the United States and Canada as being not that different, say, the trade from New Jersey to New York. It just, across the border, pretty routine. And so companies are able to do things on either side of the border. So I think this is a bigger structural change, and my guess is it's not just a one-off kind of temporary little bump in prices of a few limited goods. I think this is probably going to be more disruptive, move quickly and break things. This is kind of the mode that it seems like heading toward, and that could have bigger, more important consequences for the economy.
So Andrew, though, if we get the deregulation and the tax cuts sooner rather than later, can that help offset this and makes the Fed's job a little easier?
Well, the problem here is the consumer is 2/3 of the U.S. economy, and consumer sentiments dropped 10 points according to the University of Michigan latest survey. Other measures, a little bit different, but the consumers are worried. The polls I've seen, 3/4 of consumers now indicating that they're having trouble making ends meet. And so we're talking about a big share of the goods that people buy every day going up in price. Consumer spending already slowed in January, and it could slow further. And so for many companies, small companies, medium, larger companies, that base of consumer spending and retail sales is a big part of what drives their investment. And so we'll see. But I'm certainly much more concerned today than I was a few weeks ago.
All right. Well, it's kind of interesting, though, too, Andrew. We talk about this idea of what consumers are looking at, and we know they pay very close attention to some of those short-term things that the Fed likes to strip out. What's going on at the gas pump? What's going on at the grocery store? We're up almost 30% in grocery store prices just over the last 5 years. And you put that up against what we saw in the previous 15, 20 years, nothing compares to it. And people remember that. So when we talk about inflation expectations and whether they're anchored, I guess my question here is, what exactly is the Fed looking at? If they want to strip out some of those measures, then they're stripping out expectations.
Okay, so it's a great question. Just two clarifying points here. Number one, service prices have been rising briskly over the last several years without much sign of slowing down. Chair Powell called it supercore. And you look at those supercore measures, they're still way above where they were pre-pandemic. The good news the last couple of years is that a lot of the merchandise goods that consumers buy, those prices have been falling or at least flattened out. And so what the Fed looks at, they call it the core inflation measure. As you say, it's taking out the food and the gasoline, but looked reasonably good over the last couple of years. A little bit off target, not too bad. And the issue now, I think that the tariffs are raising is that a lot of those goods prices may well start rising. And so then the whole picture, not just food and gasoline, not just rents and housing, not just services, but even the goods prices now starting to head back upward. The Fed's going to have to pay very close attention to this.
I am curious as to what a change in Fed policy could even do in this situation. I'm talking about the potential for rates to be cut primarily because of the economic effects of the tariffs. But when we think about what these tariffs are meant to do, and the idea that, at least if you believe Trump at his word, that he's probably going to keep them there for some time to extract the revenue that he thinks he can extract out of it, does cutting rates even do anything in that situation?
Well, I think that the difficulty for the Fed, they have a dual mandate, maximum employment and price stability. They have to pay attention to both. And the problem with tariffs is that their first order effects are stagflationary because they tighten consumers' pocketbooks. Consumers have less money to spend. The consumer spending, slows down, which hurts employment. And at the same time, the tariffs are pushing up the inflation rate, which works against the price stability. Now, how the Fed balances that out, of course, is it's a big challenge. But I think there's going to be a case in the next 6 to 9 months if the tariffs don't just have direct effects; they have indirect spillover effects, and goods prices across the board are starting to go back up. The Fed will have to pay attention to that. The Fed will have to be prepared to change course and stop talking about cutting rates and possibly need to actually tighten the stance of policy.
Wow. So they might actually have to tighten because of the inflationary impacts. What would that do to the economy in a world of tariffs?
Well, just to be clear, usually we're thinking about a very small, contained tariff on a specific good or service, where, as you mentioned earlier, just a transitory one-time jump in the price level. But here, I think we're talking about a much bigger structural change. There can probably have to be a lot of changes in the ways that businesses do their production and planning and supply processes. And that process of changing things over is going to be expensive. I remember this, after 9/11, there was a lot of changes that had to be made in security across the country. It took time and it was very expensive. And a lot of prices of a lot of things went up as a result of that. So I think we're going to see something similar here, probably over. It's not going to be a month. It's going to be over the course of a year or two or more.
All right, Professor, really appreciate you taking time for us. Andrew Levin, Dartmouth College professor of economics, who spent a couple decades at the Federal Reserve Board in various positions there. We should just point out real quickly here, stocks now off the highs. That dip buying you saw giving way to some intense selling pressure as we get closer to these closing bells. Just about 21 minutes away. Stick with us. This is Bloomberg. The Bloomberg Investment Conference, a two-day conference taking place here in New York. We've already heard from Harvey Schwartz, the CEO of Carlyle, Ray McGuire, president of Lazard, and New York Fed President John Williams. Let's go back down to Lower Manhattan, where Cathie Wood, the founder of Ark Investments, is sitting down right now with Joe Weisenthal and Tracy Alloway.
Have you observed anything tangible, say over the last several weeks, that to you suggests that there is some change at the margin DeepSeek aside, in how much businesses, hyperscalers, et cetera, are throwing at AI right now?
I have not seen any change in
There's no evidence of a slowdown.
The power of these models is profound. And if anything, we just had a conversation with one of the largest LLM. We're under an NDA, so I can't talk about which one, providers. And it's clear that nations, educational systems, and enterprises are all saying, we have got to do this. This is transformational in so many ways. Many are talking and thinking about productivity and efficiency. But others are thinking about deep research, especially with the new reasoning models, and deep research is one of them, and are just blown away by the results that we're getting. So I'm not seeing any slowdown at all.
So you mentioned the fact that DeepSeek is open source, and that was a big differentiator between it and some other models. I know you're a big fan of open source. How do you incorporate that aspect into, I guess, an investment analysis? And also, did OpenAI make a mistake by not going open source?
Well, we've been tracking closed models and open source for ever since the ChatGPT moment. And what you'll see is the closed models have been ahead of the open source models. But if you look at the slope of the line of the performance improvement, open source is actually a steeper slope. So the reason I love open source is it is helping along the competition, helping the movement along, helping it go faster. And I think that open source nipping at the heel of closed is a very good thing.
So, ChatGPT came onto everybody's radar, I guess, late 2022. And I think objectively, anyone who spends any time with these tools, in a sense, it's just absolutely jaw-dropping, right? Are you surprised, however, that we're like this far into it and the tools are so, in some sense, extraordinary, but we could talk about some of the flaws and limitations, and yet we really haven't seen much of a macro impact from their use. We haven't seen some sector of the economy or the labor force get laid off. We haven't seen some major surge in measured productivity gains, although that's infamously hard to measure. Are you surprised in any sense by the existence of the technology and what seems like sort of a modest macro impact?
So I do think productivity has been boosted to some extent. And you're right, it's very difficult to measure this. My background's economics, and in the 80s, productivity was a big question mark, and we saw how flawed the measurements are and probably still are. So I can only tell you the rate of uptake is that enterprises are seeing a difference. Maybe if they're not laying people off, they're not hiring them. And we know that, and that's because these AI tools are making their own, especially engineers, so much more productive, right? So you just don't have to hire that next person. If you've seen the number of coding employees in the United States has dropped like a cliff. I mean, off a cliff. It hasn't dropped like a cliff, it's dropped off a cliff. And I don't know if you've seen that chart, so that very much has happened as engineers just become more and more productive. One of the things that we're wondering is, okay, what part of the software stack will the traditional software stack, will this impact? And we think the AI revolution is what we see already losing share to some extent. It is still growing, but losing share is software as a service. And, I think we're all paying very close attention to the revenue growth dynamics of these companies. A Salesforce.com, revenue growth isn't picking up. In fact, it continues to decelerate. I think it's next quarter will be, 7% down from 9%. That's not what's supposed to happen here. And so I think that might be what you're referring to. Wait a minute, where are the top line dynamics? Where are they coming from? Well, I think we have a lot of entrepreneurs in a lot of garages or in R&D centers who are creating the next big thing. And, we look at two profound ramifications of AI that we understand. We've been researching them for so long. The largest AI project on Earth is robotaxis, autonomous driving networks. We think that's going to drive $8 to $10 trillion in revenue globally in the next 5 to 10 years, up from zero now. So that's called embodied AI. The most profound application of AI, we believe, is going to be in healthcare and the convergence of sequencing technologies, artificial intelligence, and new technologies like CRISPR gene editing are already curing diseases. Sickle cell disease and beta thalassemia cured. CRISPR Therapeutics has that cure. It is generating revenue now. People find this one very hard to believe because it hasn't happened before. But the R&D explosion in healthcare is like nothing I've ever seen. And we think we're going to return to the golden age for healthcare. I started in the 80s when Genentech had taken off and created the golden age for healthcare back then. Returns to R&D back then were in the 30% range. Today, for the broad-based pharma biotech field, the returns are down in the 4% range. We think with all of these new tools and the incredible productivity being added to research and discovery in the healthcare space, we're going back to the golden age where returns on R&D could be 30, 40% plus.
Shameless plug for the podcast here, but we have a really good episode coming out on biotech that walks through a bunch of the AI implications as well. True. But since you mentioned robo-taxis, we got to talk about Tesla.
Of course.
Obviously a big component of your portfolio. Elon Musk seems very busy nowadays, to put it mildly. As an investor, do you worry at all that he is perhaps distracted from ostensibly the day-to-day running of the company?
We've been getting this question practically since the beginning. So Tesla, and then he starts all these other companies, right? And people are saying, does that not concern you? So I'll answer that first, then we'll bring in the government overlay. The reason it doesn't concern us is Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies, really catalyzed by AI. And he understands that the name of the game in terms of who's going to win all this, through all of this, are those companies that, number one, have deep domain expertise. They take AI seriously and they're investing in it. And perhaps most important, they have data that no one else has, proprietary data. Think of all the data spewing out from all of these companies. Even Neuralink, that's biological data. And the most prolific data explosion out there is in the healthcare space. We have 37 trillion cells in our body. And they turn over every quarter. And now we have something called single-cell sequencing that we can combine with AI to unlock the secrets of life, health, and death. And that's what we're going to do. He understands that. Neuralink's a part of this. Okay, overlay in the government sector. I agree. He's doing something certainly for his country. I know he believes that.
He's tweeting a lot, that's for sure.
He's what?
He's tweeting a lot.
He always has tweeted a lot, right? He always has tweeted a lot.
You've been listening to Cathie Wood, Ark CEO and CIO, and Bloomberg's Tracy Alloway and Joe Weisenthal at the Bloomberg Invest 2025. Romain, I got to say, we are fading as we head into the close here.
Yeah, and I kind of had a feeling there wasn't a whole lot of conviction in that trade. Remember, when we talk about that big rebound that we had seen in the middle of this session, a lot of that really was just to some of those big cap names. And that clearly was kind of signs that that was more of a defensive rotation rather than an embrace of, say, an extension of a broader rally.
Yeah, I mean, financials are still getting hit really hard, along with most cyclical names as well. The KBW Bank Index at one point saw the worst sell-off since March of 2023. I mean, these superlatives are quite something.
And I was just taking a look at market breadth, at least when you measure it as the difference between 52-week highs versus 52-week lows. We're in negative territory now for an 8th straight day. That's the longest streak we've been in, had negative breadth, at least since December.
JP Morgan U.S. Market Intelligence this morning had their note out saying that they're turning tactically bearish and think because of the tariffs, we're going to see growth estimates continually lowered all across the street. Michael Feroli was already out with 1.5% for the first quarter GDP as of yesterday, before the tariffs took effect.
Yeah, and we spoke with Mohamed El-Erian a little bit earlier, and he basically said those numbers have to come down, those economic forecasts, basically just too high right now.
Yes.
All right.
It's true. You are right.
It is true. We continue to count you down to these closing bells. We just got about 7 minutes to go here. A market was struggling for direction here. It had a push into the green after a drop of about 2 to 3%, depending on what indice you're watching, but now back into the red as we get closer to those bells. Mona Mahajan joining us right now, senior investment strategist over at Edward Jones. And Mona, maybe you can provide a little levity here, because we talk about a market that, let's just face it, 57, 68 and change on the S&P. Look, I know we were above 6,000. We're not that far from our record highs. Similar for the NASDAQ here. Do you see additional and meaningful selling pressure ahead? Or is this maybe just something that the market and investors will digest and find a way to find bargains and buy back into this market?
Yeah, it's a great call out. And look, Romain, we have been up for 2 years in a row, 2023 and 2024 in the S&P 500. We're up 20% plus each. We are up about 60% since the start of 2023. And to your point, we are now about 6% below the all-time high in the S&P 500. Now, you could argue we were due for a bit of a pullback, a correction, at least a period of consolidation. But we have been trading sideways for quite some time. In fact, if you look back since the day after elections, November 6th, we are essentially flat to that day. So about 4 months of sideways trading in the S&P 500. That in itself is a bit of a corrective phase. Now, keep in mind, we are seeing what we'd call a softening in economic data. Many of us have called it out already, but areas like retail sales, PMI numbers, even things like the GDP Now forecast starting to point to a softening in economic growth. That is not uncommon in the first quarter of the year. What, of course, is uncommon is to overlay on top of that the uncertainty of what direction tariffs are going, what the government funding will do, and broader uncertainty about the economy going forward. And so that's where we stand right now. We think a correction could be in the offing, but certainly not one that will lead to, or what we think, conditions that will lead to recession or deep, prolonged downturn.
What about corporate fundamentals, Mona? Because we've heard a lot from corporate executives kind of hedging their bets here on their forecast for the rest of the year, talking about price pressures on them, price pressures that they could maybe try to pass on to consumers, and maybe a potential effect on revenue growth and, for that matter, profitability.
Yeah, corporations are in a tough spot because they want to spend, they have the budgets, but they have a little bit of uncertainty ahead of them. It's not only the tariffs, it's what's going to happen with taxes. It's what's going to happen with deregulation. The hope is we're starting with the less growth policies up front, tariffs and maybe some immigration reform, but followed by what will be potentially helpful for corporations, which is deregulation and at least some stability and clarity around taxes. What we'd say broadly is last quarter, Q4, 16% year-on-year earnings growth, the best quarter since 2021 in terms of earnings growth. We are still looking at double-digit earnings growth for this year. Now, that has come down probably from 14, 15% range to maybe 10 to 12%. But nonetheless, we do think there is optimism and hope that corporations will eke out not only better profitability this year, but that will be driven by both tech parts of the market, but non-tech parts of the market. Think the S&P 493 finally showing signs of life from an earnings perspective as well.
I know, Mona, we got to get to those tax cuts, though, and there's a long way to go until we get there. How do you hedge that time?
Yeah, look, we have said for quite some time now, and it's a tried and true strategy, but diversification remains essential this year. And that, of course, has already yielded some benefits. If you were diversified within the U.S. growth and value parts of the market, across asset classes. So, of course, stocks and bonds. Bonds have held up quite well, have been that flight to safety, and U.S. and international. And what we're seeing, of course, is areas like Europe and Chinese technology, for example, have led the way higher in global markets. Now, will that be sustainable? Will they be the leaders in the next 1 to 3 years? We'll see. Depends on the productivity gains the U.S. can continue to eke out here. But nonetheless, we think if the theme of the last year and the last 2 years was all about mega cap tech, concentrated portfolios, we know the theme of diversification really will matter in the year ahead.
Not to talk about corporate credit right before the closing bell, but investment credit has started to actually show some cracks in a different place than we were like 8 months ago when it came to the corporate credit market. Does that give you pause for those 493 other stocks?
Yeah, look, we had all seen the trends in corporate credit, especially the high yield credit markets, where spreads had been tight for such a long period of time, probably because the economy was holding in quite well. Now, we are still more cautious on the high yield credit market. We think there could be some widening of spreads, which, by the way, may create some opportunities down the road. But we are still pretty positive on the investment grade credit market. In fact, if we do see yields start to stabilize, move back higher, there could be an opportunity to extend duration once again. Yeah. Keep in mind, this is also a Fed that is now back on the table in a very meaningful way. We came in thinking 0 to 1 rate cuts this year. We could be looking at 1 to 2, and I know some are talking about 3 rate cuts, but nonetheless should be supportive of the credit market broadly.
All right, Mona, got to leave it there. Always a great conversation. Mona Mahajan, senior investment strategist over at Edward Jones, counting us down to those closing bells. And this has been a pretty wild day, Alex. We were down 2% on the S&P, then we were up about 1% on the NASDAQ, and then that kind of flipped back down. And as we head back into the close, not a whole lot of conviction to buy anything right now.
No, you definitely don't love to see that momentum fade into the close like that, sort of bouncing around some moving averages and then not able to hold out those levels. So could get really ugly. All
right, we're going to give a full breakdown of everything that's happened today, and we do get some earnings after the bell. I'm Romaine Bostick alongside Alex Steele. Scarlett Fu joins us as she does every day at this time. Also joining us around the desk is Bloomberg News' Jess Menton, who helps to lead our equity coverage. Welcome to the party, guys. I didn't know if we were going to be talking about the great sell-off, the great rebound, but it looks like, Scarlett, we're just kind of getting something in between.
Yeah, well, we're getting a little bit of everything, right? Yeah. I mean, we had the big sell-off down 2%. At one point, we halved it, and we went into the green. Now we're back down about 1.2%. Some key technical levels here that were breached momentarily for the S&P 500 and the NASDAQ, especially for the NASDAQ 100, got within spitting distance of that 10% correction from its record high.
Yeah, and also kissed that 200-day moving average on a intraday basis for the first time in 16 months. It's right across the screen, guys. Hate to break it to you. We opened lower, we rallied higher, but we're going to end the day back down in the red with the Dow down almost 700 points here on the day, or about 1.5%. The S&P down 71 points, or 1.2%, while the NASDAQ composite will finish the day lower by about 65 points, or 0.4%. And your big decliners here on the day, you're going to find that in the small cap space. Russell 2000 down 1%, the mid caps down 1.5%, and Dow Transports, guys, down 2% on the day.
All right, let's take a look at the movers. You have within the S&P 500, 417 stocks lower, 85 stocks higher. And you look at the IMAP, that big slice of green is tech, but it's not really green. It's little change at this moment, 0.01%. That's the only sector that didn't decline. The worst performers, I know you guys have been talking about this, the financials led lower by the banks, losing 3.5%. Then you have industrials losing 2%, and consumer staples, they've been beneficiaries of this flight to defensive stocks. That group is down by 1.8%.
Yeah. Absolutely here. And before we get to some of the movers on the day here, we are getting some additional earnings, particularly in some of those economically sensitive areas. And that includes retail. Ross Stores out with its report. And at least for the fourth quarter, they did beat estimates on the bottom line. EPS coming in at $1.79. The street was looking for $1.68. Sales growth, well, there was no growth. It was down 1.8% on a year-over-year basis to $5.91 billion in sales. That's below what the street was looking for. And inventories, though, rose up 12% to $2.44 billion, and that's higher than than what the street was looking for.
I just want to point out, in the press release, they have not mentioned tariffs yet. So definitely going to be a focal point on the call, particularly after Target and Best Buy.
Worth noting as well that Ross has raised its quarterly dividend by 10% to 40.5 cents. So these off-price retailers feel like they're in a pretty good position. That boost in its quarterly dividends feels like a vote of confidence from the company.
And especially when you're looking at retailers. So speaking of those, I'm going to start off with the decliners this time instead of the gainers just for today, since we are talking about the retail space. So looking at Best Buy specifically here, I mean, that stock was down over 13% through the close, the worst day since March of 2020. And of course, we've known that there's been ongoing issues and struggles with this company. And what's interesting about Best Buy as well as Target is their executives were talking more about what the potential hurt from tariffs could be to their corporate bottom line. So that's why you started seeing more pressure there for when it came to Best Buy. But then Target also, I mean, the declines today, TGT is the ticker symbol on this, down about 3%. So not as steep as the loss that we would have seen in Best Buy. So that was Target's worst day since actually just February 21st, so just a few weeks ago. But looking at that, that also was pressured amongst the outlook because also Target's in a more unique position than compared to some of its rivals when you think about Walmart. Walmart's been trading like a growth stock over the past year, so it's very hard to have comparisons between the two. And then also Target was more of a darling during COVID and has problems coming out of that was more people weren't stuck at home and spending on those discretionary items.
Yeah, and I mean, and there's just the potential tariff impact. I mean, we talk about some of the weak spots in the market today. I mean, it wasn't a lot of those discretionary items, the durable goods, the household durable goods that ostensibly we pretty much all make overseas right now.
Exactly.
Yeah, and so that's a big thing, of course, when you're looking at the outlooks for corporate earnings, because not every company gives out quarterly guidance or annual guidance, but about maybe a quarter of them put out quarterly guidance and about 60% put out annual. But so far, I mean, Walmart, of course, is one of them, but we've been seeing those tariff impacts as well as when it comes to the dollar, those mentions with Apple as well as Amazon.
Were there any bright spots today?
Of course,
maybe a tech company?
Yeah. Actually, there were. So SMCI, I have to point that out because it has had problems, and of course, it went into the S&P 500 a little under a year ago, so March of last year. So still had a max drawdown coming into this week, more than 50% from that all-time high, but actually up 8.5% today, best day since February 26th. But of course, on February 25th was that deadline that it had to meet in order to not be delisted from the NASDAQ.
Also, Enphase Energy was also up today, too. Like, that felt like a little random rally there. I just want to break in here and talk about yields. You saw gainers and winners and losers, but I'm taking a look at the bond market. So interesting because you did see a bid into the bond market earlier in the session, of course, as you wound up seeing equities sell off. Then that kind of reversed in the middle of the day, and you saw some selling on the back end in particular with yields rising. They still are, but you are seeing a little bit of buying in the front end. Guys, remember, it looks like traders are looking at a 50% plus chance of a cut in May. The market pricing in 3 cuts potentially for this year. You can see that reflected a little bit in the front end, but that back end still selling off. That's a growth scare if I've ever seen one, right?
Yeah, and then Mike Kontopoulos, he was on the program yesterday, talked a little bit about that.
That was like a million years ago. So much has happened.
We can't figure out where yields are supposed to be. How are you supposed to price stocks? I mean, doesn't that always come down to it? I mean, the Treasury market has seen so much volatility.
I would love to actually see some of these models, these internal models at Wall Street, because I assume they're just changing every day, right? I mean, because you talk about that denominator having to basically change, and now that could change in a big way if you believe what the options market is starting to price in, Scarlett.
All right, let's take a look at some more earnings. We've got news on ChargePoint. Of course, it's an EV company, infrastructure company, reporting results. Fourth quarter revenue meeting analyst estimates. Fourth quarter revenue at $101.9 million, just slightly higher than what was anticipated, which was $101.4 million. In terms of its outlook for this quarter, first quarter revenue anywhere from $95 million to $105 million. So the midpoint of that would be $100 million. That's slightly below what analysts were looking for, which was $101.3 million. The stock right now slightly higher in after hours trade.
Yeah, we're still waiting on earnings out of some other retailers, including JW and Nordstrom. We are getting earnings out of Flutter. This is the mobile gaming company. Adjusted EBITDA in the quarter coming in a little bit light at about $655 million. The street was looking for $673. Revenue also coming in light in the fourth quarter, $3.79 billion. Street was looking for $3.82, and its guidance for the full year in 2025. That revenue guidance, $7.47 billion to $7.97 billion. The top end of that range is above the average of street estimates. The low end of that range is below it. Alex?
Yeah, not to harp on Ross for a second, but I'm going to harp on Ross stores for a moment because they're coming out with a full year comp sales. They're looking at down 1% to up plus 2%. The estimate was for 2.86%. So definitely a decline there. I'm really interested to see if we learn anything more on those tariffs and if that actually incorporates tariffs. Remember, with Target and Best Buy, their outlook did not incorporate it, which made it even less impressive, their outlook for the year.
And to that idea that they don't have that much visibility for the full year, for this first quarter, comparable sales will be anywhere from down 3% to unchanged, when analysts were looking for 2.65% as a gain. So that's a pretty big miss in terms of immediate visibility for the next 2-3 months.
Something I'm keeping a close eye on is the cloud-based platforms here. So Box reporting after the closing bell here. So seeing first quarter revenue around 274 million to 275 million. So that estimate was around 279.5. So you're looking at that stock, and especially because over the past year, it's actually been up around 20%, but only up close to 6% year to date. So keeping an eye on that fiscal adjusted EPS as well. As far as when you're looking at that revenue forecast, especially for the first quarter, trailing estimates, that's why you're seeing some of those shares pressured.
And I just want to make a correction, too. I mean, I was saying that we were waiting on Nordstrom. I actually forgot. They actually reported this morning here. So just a correction on my part. They did report with fourth quarter comp sales up about 4.7%. Jess, I'm sure you've had a busy day.
It has been.
She was on surveillance this morning.
On
radio.
I was with Tom King,
Radio
7 to 10.
Yeah. Well, I hope you're staying up. We got a State of the Union State of the Union speech later tonight, and maybe more potential market moving stuff. Jess Menton, who leads helps lead our equity coverage here at Bloomberg. I'm sticking around. Alex, I believe you're taking off. Scarlett is sticking around too. We got a lot more coming up here on the big program as we look into the retail space, with retailers announcing a slew of store closures so far this year. Almost 4,000. Deborah Weinswig, CEO and founder of Coresight Research, she's going to be joining us next to talk all about it. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Another wild day on Wall Street. We came in today and it looked like we were in for a brutal sell-off. Sometime around the middle of the day, the dip buyers did step in, taking the S&P 500 from a 2% loss to almost a 1% gain on the day, but then that faded as you got closer to the closing bells. The net effect of it is an S&P 500 down more than 1% on the day. Similar moves for the Dow. The NASDAQ only down fractionally on the day, but the selling pressure was intense as we got towards the close. You see the elevation in the VIX, which did top 24 on the day. And take a look at financials. That had been one of the bright spots in this market here. A 4.56% drop on the day. That's the biggest one-day decline for the KBW Bank Index, going all the way back to March of 2023. Bitcoin, though, did actually absolve itself here. It was deep in the red, and it looks like it's going to finish out the day, Scarlett, in the green. Any other bright spots out there?
A couple of bright spots. You mentioned the dip buyers. They showed up in force for some of the tech names. NVIDIA up 1.7%, rebounding from a 6-month low, also recovering from its biggest loss of the year when it tumbled more than 8% yesterday. Traders chalking up to a technical bounce. The NASDAQ 100 bouncing off of its 200-day moving average, and it did get pretty close to a 10% correction from its high, but didn't get to that level. United Health, another mover here, up 1.6% on the day. The insurer moving closer to getting a long-running lawsuit against it dismissed. The U.S. government sued United Health, claiming that it overbilled Medicare, but there was a legal expert who made a recommendation to the judge that the DOJ lacks evidence to support its claims. The final decision, though, is up to the judge. We're not sure when that decision will come. And Best Buy losing 13% on the day. It did fall as much as 16% after its annual comparable sales and profit forecast trailed analyst estimates. And the forecast, by the way, did not include the impact of tariffs as well. So our top story this hour really is about China and how it's set to unveil its economic blueprint for the year. Led by Xi Jinping, policymakers will likely set a bullish goal of 5% GDP growth, and getting there by boosting the spending power of the Chinese population to offset expected losses to its exports. All of this happening after the U.S. doubled a blanket tariff on all Chinese goods, which prompted Beijing to retaliate with its own targeted action, essentially putting the two largest economies on a collision course. Romaine?
Yeah, and of course, one big topic of conversation out of that, as well as the president's address here in the U.S., could be cybersecurity. We're actually getting some results out of one of the key cybersecurity companies right now, CrowdStrike. The company saying that in the most recent quarter, EPS did beat estimates, $1.03. Revenue did beat estimates, $1.06 billion. But here's your forecast for the fiscal full year. The company says that revenue will be $4.7 to $4.8 billion. The low end of that range, slightly below the average of street estimates. On an EPS basis, the company says expect about 64 to 66 cents a share for the first quarter adjusted EPS number. And that's well below what the street was looking for, which was anticipating 96 cents a share. CrowdStrike shares down 5% here in the aftermarket. Meanwhile, we were talking a little bit earlier about the retail sector. A retail sector, of course, definitely exposed, outsized exposure to those new tariffs. Joining us for a broader look right now at that sector is Deborah Weinswig. She's CEO and founder of Coresight Research. And Deborah, you guys had some research out talking about the number of store closures that we saw last year and the number of store closures that we might get this year. Talk to us a little bit about those numbers.
Yeah, so I think last year was pretty much in line. I will, the Friday kind of before the holiday week when we heard from both Party City and Big Lots, right, in terms of store closures and bankruptcies and whatnot, that to me was the demarcation line almost that things have really changed. And with the news around Walgreens and going private, you're starting to see some of these smaller box retailers versus like a Supercenter or whatnot who are really starting to be challenged, I think, beyond anyone's prediction. And that to me means that, right, the game has changed and there's new rules. And as we can see from today, they're really being put in place every day.
I am curious, though. I mean, particularly when you heard some of the commentary out of Best Buy and Target, for that matter, about the price impact on them and the idea that they've kind of made it clear that they can't just eat that cost. They're going to have to find a way to pass it on to the consumer. And I am just curious, like, what does the consumer have left at this point? Because we've talked a lot about how there could be a potential slowdown in consumer spending, or at least a shift in consumer spending away from some of the higher end discretionary goods to things that are a little bit more essential.
You bring up a really critical point. And if we go back to the week of January 13th, right, when eggs were kind of all the rage around eggflation, right? Egg prices are up since August 54%. And there's expectations that we see anywhere between 55 and 75% in price increases from here. And so if you look at, Coresight does a weekly monitoring of consumer confidence, and it dovetails exactly with that kind of time frame around this conversation of egg prices hitting kind of the wire and being front and center. And the reason why eggs matter so much is that, first of all, it's something the average consumer purchases every week, and it's 2 to 3% of their budget. And they know the prices of eggs almost like they know the prices of gas. Mm-hmm. And so to me, that also, we had an early indication of what higher prices might do. And, in the past week, we've seen, kind of with the tariff turbulence and whatnot, we've seen kind of precipitous downtrend in terms of consumer confidence. And that could, of course, translate into weaker sales.
So, of course, that's consumer staples. I want to talk about consumer discretionary and take a look at Ross Stores, which came out with a full year sales forecast and a first quarter sales forecast that missed analyst estimates. Not all off-price retailers are created equal, because we saw TJX coming out with some rare retail optimism when it reported. What is Ross Stores not doing right? Or maybe better yet, what is TJX doing right that others can't seem to get?
You hit the nail on the head. I mean, TJ Maxx, if you can believe it, is the size of the entire department store industry now. And that is a real change from, even just a decade ago. So TJ Maxx, right, there's all of these, it's kind of like Costco, right? There's all of these stories, this kind of like heritage around, right? A buyer getting a call in the middle of the night, right, that there's product available, and they literally get in their car and they drive from Boston down to New York or something along those lines. So these buyers, these merchants, they know great product, they have an eye, they're trained, and they're ready to kind of jump in at, kind of any time, truly day or night. And I think that, it's, once again, it's very similar to Costco. It's that each item focus. And truly, our belief is that many of the, and maybe it's TJ, will be a winner in a highly inflationary, tariff-ridden environment, because they buy most of their product domestically and they buy it, right, very close to when they sell it. So Stores, that was an interesting kind of, I would say, outlook from them.
So as Target and Best Buy say that they're going to have to increase prices because of tariffs, will that eventually filter through to an off-price retailer like TJX? I mean, will they at some point need to also raise their prices?
I mean, no one is 100% immune. And so the thing, right, you can look at the goods for sale and the goods not for sale or not for resale. So fixturing, shelves, cash registers, whatnot. Those items, right, there will be inflation, and that could be higher than what we see in the rest of consumer goods. So, yes, you bring up a very good point that we shouldn't forget. No one is 100% immune, but some who source more domestically are, of course, able to, at least in the near term, rethink that. Mm-hmm. And Target, right, they did talk about only 17% of their goods are coming out of China. They've been moving, into other geographies for a while. But once again, they still have a presence there, and they have a very complex supply chain. The key to this, if I were to think about investing, think about who has the most simple supply chain and invest there, and TJ Maxx is at the top of the list.
All right, Deborah Weinswig, CEO and founder of Coresight Research. Thank you very much. We're also, of course, paying attention to On Holdings AG. The shares of that company closing up almost 6% after the Swiss sneaker maker predicted strong demand will continue for the sneaker company, the sportswear brand overall. This is a Roger Federer-backed company, and its revenue beat estimates for the fourth quarter, and the company sees 2025 revenue growing at least 27% on a constant currency basis. Let's bring in now Martin Hoffmann and Marc Maurer. They are co-CEOs of On Holding from the New York Stock Exchange. Gentlemen, good to speak with you. I want to start with your outlook, because it makes clear that you anticipate this net sales growth rate of 27% on a constant currency basis. With the U.S. threatening and imposing tariffs on North American countries and now eyeing Europe, how are you managing currency volatility? Is there any way to get ahead of that?
Yeah, we had an amazing finish to a very strong year. We just posted the strongest quarterly growth for the whole of 2024 with more than 40% growth. We already had a very strong start into the year, which gives us the confidence behind the guidance that you were just talking about. We invested a lot of love into building the brand in the last year during the Olympics, through our partnership with cultural leaders like Zendaya, with big sports people, and we have an amazing product pipeline. So we feel we are set up well for 2025. We ended the year with a lot of momentum, with a lot of products that are launching and have launched. Our biggest franchise, the Cloud, is just launching in 2 days. At the same time, we monitor, of course, the situation, both from a demand perspective and a tariff perspective. Luckily, we have very little production volumes coming out of China. We are mainly sourcing in Vietnam and in Indonesia, but this is a situation to monitor.
Absolutely. So given that most of your production is in Vietnam and Indonesia, Mark, I'm wondering if you are looking to diversify that even further, because at some point the U.S. might take aim at those countries.
Yes, we're always looking to diversify, not only from a tariff perspective, but also to make sure we can produce closer to where demand is. So we've already diversified apparel into Europe a lot. And then we launched Light Spray as a key innovation, which is a product that is sprayed. And what that allows us to do, it allows us to eventually produce where the consumer is. So I think this is really a very big step, not only from a production location perspective, but also how we can increase the sustainability in the whole product pipeline.
I am curious, though, Mark, how much visibility do you have going forward when you talk about trying to keep a tab on economic conditions globally in all of your markets at a time? And let's just face it, the chaos that we're seeing here in the U.S. is not limited to the U.S. Europe is going through issues. Obviously, there's a lot of issues in Asia here. So how much confidence do you have in your forecasting abilities?
Yeah, we feel we have a lot of confidence in who we are as a brand. So I think we very much observe where the consumer is. We are a global brand, so we're serving consumers in many, many different countries. But what we see is that our brand promise of being the most premium sportswear brand, very much driven through innovation, is really resonating with the consumers. And they're more and more buying our product in our own channels. We still have a lot of room to expand our retail network. We have a lot of room to expand our overall brand awareness. We doubled brand awareness in the US. We more than doubled brand awareness in Asia Pacific. So we feel, even though we are already at a certain size, we still have so many pockets of growth so that we can capture that incremental demand, even though consumer demand in some of the markets is a little bit less stable.
All right, so we're talking 100 billion in sales now, obviously a very significant milestone here. When we talk about what the longer term evolution of this brand is, what does that look like to you? Because I know a lot of people want to look at On and they just say, okay, is this going to be the next Nike or Adidas or something else? Or maybe it's going to be something different. What's your vision?
So we want to be the most global premium sportswear brand. And the word premium is very important in this. We feel we have a very clear position in the market with more premium price points than many of our competitors, with products that are really rooted in performance and design and sustainability. We started in running, we ventured out into tennis, and have really reinvented how you can play in tennis. We do the same in training now, in outdoor. There are many more sports that we can talk about in the future. Mark mentioned we have built a global brand, but really we want to fill that space between where sportswear is today and where luxury starts. And we feel we have a unique position there. If you go into an On store, it's a very different premium experience than in other stores. And that's our goal. And so we take it from year to year.
Yeah. No, and thank you for explaining that. It's helpful. And I want to just piggyback off of what Romain was asking about when it comes to Nike. They have a new CEO, Elliott Hill, and they've put a renewed focus on women. You can see that with their Super Bowl commercial. And of course, their recent partnership with Skims, launching this new fitness brand. From where you sit, Mark, is Nike a more formidable competitor now than it was 6 months ago before Elliott Hill was named CEO?
No, I don't think we look at it that way. We very much try to focus on our space, and Martin already explained that. We see ourselves as playing a little bit above some of the other players, almost kind of where the other players stop from a price point perspective. And we're focusing very much on the product innovation that we're bringing to life. And I think what we've proven is that we're able to tell very differentiated stories compared to some of the other players. So our partnership with Zendaya is exactly capturing that female audience. It's capturing a younger audience. Our soft campaign that we just launched with Elmo is really resonating, and it's differentiated. In a world where most of the people are hard on themselves, we're trying to counter it, and we're trying, to deliver a message of how can you be a bit softer on yourself. And I think this is the journey that we're on, and we see it's resonating with our consumers. So we're very positive on the outlook.
And you certainly saw that in the stock. Martin and Mark, really appreciate both of you taking time for us, the co-CEOs of the sneaker company On Holding down at the NYSE. There are some headlines crossing the wire on the trade front. The Commerce Secretary of the United States, Howard Lutnick, telling Fox Business that he actually does expect a compromise on tariffs, an announcement of a compromise likely tomorrow. Those are his words here. Not quite sure exactly what that means. Another headline now crossing the wire saying that Trump may lower the Canadian and Mexico tariffs tomorrow. Again, that's according to Howard Lutnick and comments he's making to Fox Biz. Scarlett, we should point out that futures right now, at least on the S&P, are up about 0.8% from where they closed the day. NASDAQ futures are higher. The loonie strengthening by a huge margin, as is the Mexican peso here. So quite a bit of turnaround. And this was kind of what everybody was saying is like, yeah, this is dire, but just wait a day, maybe it all changes.
Moving targets.
Yeah.
The goalposts keep moving. The other thing is the EWC, which is the ticker that tracks the Canadian stocks ETF. That is also higher in after-hours trading, as is EWW, which tracks Mexican stocks. That is slightly higher as well. Yeah,
something to keep an eye on there. We should also just point out, too, Howard Lutnick, the Commerce Secretary, will be joining Bloomberg tomorrow morning on Bloomberg Surveillance. So definitely tune in to John, Lisa, and Anne-Marie for that conversation. Meanwhile, we keep rolling on here on The Close, a look ahead to the President of the United States' big speech to Congress. Greg Valliere, Chief U.S. Policy Strategist at AGF, joins us next. This is Bloomberg. We are officially at day one of the Trump tariffs on Mexico and Canada. And well, if you believe the Commerce Secretary of the United States, well, day two, they might actually roll that back. Howard Lutnick actually speaking with Fox Business just moments ago, saying that Trump may lower tariffs on Canada and Mexico tomorrow. Scarlett, him talking about the potential for a compromise announcement tomorrow.
Yeah, and you're seeing the currency market react, right? The dollar's weaker versus the loonie and the peso. So those other currencies are gaining. We're also seeing 2-year yields and 10-year yields poke above, move into the green. So that means that there is selling of treasuries right now. It's a whirlwind for everyone here.
And of course, the backdrop of all this is, well, you actually have a big speech that the president is scheduled to give later tonight before Congress. Not the State of the Union, but we'll certainly get some sense here of the president's policy initiatives going forward. Greg Valliere joins us right now, Chief U.S. Policy Strategist at AGF Investments. And before we get to that speech, Greg, I just have to ask you about just the general strategy. We kind of knew coming into this administration that Trump is erratic. He just governs a totally different way, and we knew that going in. But this whole brouhaha over 25, 25, and 20 on Mexico, Canada, and China, and now Lutnick, barely 24 hours later, saying that, well, tomorrow he might actually reduce this. What am I supposed to make of this?
Yeah, Scarlett just said the little boy who cried wolf. This is really, if accurate, an extraordinary development that a nasty, ugly stock market sell-off in less than 48 hours convinced Donald Trump that this was hurting him politically. You have to ask the question, what other things come next, whether it's layoffs, whether it's Ukraine, maybe they cave on other things as well.
Oh, go ahead.
Oh, no. I just want to jump in here for a moment, Greg. So does that mean that we just saw the Trump put in action? There was a lot of talk about how once the S&P 500 erased all of its gains from Election Day, that there would be some kind of verbal intervention. Was this it?
Could be, or there could be another bombshell tomorrow. I mean, this is a very erratic administration, obviously. But I do think they felt that the polls were really turning. And to see the polls turn, to have a controversial speech tonight, they still have to deal with Elon Musk and Ukraine. I think they realized they had too much on their plate.
Yeah.
So they caved.
Yeah, I mean,
apparently will cave.
Yeah, apparently. But then you kind of wonder if the damage is done. I mean, let's face it. I mean, markets run on narratives, they run on perceptions. And even if you reverse course here, sometimes that sort of stays in the sand. I do want to get your take on what you think the president's sort of general tone is going to be later tonight. We sort of know the hot button issues that he campaigned on and what he wants his presidency to be. But I guess the question is, how do you communicate that, particularly to a Congress that is going to be completely divided? We're already hearing that some people are already planning walkouts, and a nation that is completely divided on whether he's good or bad for us.
It's a tough task. There's so much, as I mentioned, there's so much on their plate. I would say that the biggest, most politically significant issue tonight is going to be food inflation. I think that the Trump administration has been taken aback by how tough the criticism is, and he's got to talk about what he would do, whether he has a plan to deal with food.
Yeah, and I mean, he basically was on the campaign trail and said, day one, we're going to get egg prices down. And day one was about, DEI, immigration, and a lot of the other issues that I know he campaigned on. But people are waiting for him to sort of tackle some of these economic issues that could potentially be beneficial, not only to the markets, but just to everyday Americans, Greg. The question, though, is a lot of those policies are going to have to go through Congress. We're now talking about changes that he just can't do through executive order. Does he have the votes there to do some of those things?
You make a very good point, because we're looking at another crisis within 2 weeks, and that would be a budget crisis. The House and Senate, Republicans in the House and Senate are not in agreement, and it's possible that we could have a government shutdown. So there's still another big crisis, and the name of that game, you're absolutely right, is who has the votes, and I'm not sure Mike Johnson, the Speaker of the House, has the votes for a deal.
So, Greg, as we follow all the headlines on tariffs, they're on, they might be rolled back, and of course the threat of more tariffs against places like Europe. What's happening in the background that perhaps we're not paying enough attention to that you think is super important?
Well, I think it is the budget. They have not come close to an agreement. There's a disagreement on how much you cut Medicaid, which is extremely controversial. I think it could be well into the summer before there's a budget deal, and that has not really gotten much traction because of all these other issues.
How much is President Trump paying attention to the budget negotiations? Because that first House vote really only got through because he got on the phone and yelled at a couple of Republicans.
Right, you're right. Yeah, it only made it by a couple of votes. And I think that Johnson, the Speaker, does not have those votes. The other big part of this story is the Senate. And you need 60 votes to get a budget deal done in the Senate. They're not remotely close to 60.
Yeah, not at all. But this gets to this idea, though, too, Greg. I mean, we kind of dance around this idea that we have seen. I don't put this delicately, but kind of a skirting, I guess, of normal sort of procedures in terms of getting things done in Washington. And I know there are a lot of people who voted for Trump who wanted to see exactly that. How much do you think he can do without Congress?
I think he can get some things done. The public, I think, feels that the firing of these people has been harsh. But at the same time, I think the public overwhelmingly feels the government is bloated, totally bloated and out of control. And if Trump can show progress in shrinking the size of government, that would be a big victory for him.
I have to ask you, too, about where the Democrats are in all this. We're going to get the Democratic response after this speech, as is traditional for the party not in power. We haven't heard a whole lot from them, at least not at a leadership level. And I am just curious, is there any plan by the Democrats right now?
I keep saying ad nauseum almost every day, no leader, no agenda. There's no leader that I can think of who really has taken the reins. And when it comes to an agenda, they can oppose Trump, but I don't see them coming up with anything new.
All right, Greg, thank you so much. Greg Valliere, Chief U.S. Policy Strategist at AGF Investments. Of course, he will be paying attention to President Trump's speech to Congress today, as will we all.
And Alyssa Slotkin, I just wondered why I was kind of blanking on that. Of course, the Michigan senator, she's going to be giving the Democratic response, which is kind of key that they picked Michigan. Because remember, that was a huge battleground state that Kamala Harris did very poorly in relative to how Biden performed there in the previous election cycle here. And of course, they're kind of at the center of a lot of the hot button issues, whether it's immigration, whether it's nearshoring, offshoring, things like that here, given the auto industries there and the big populations they have of Polish Americans, Ukrainian Americans, Muslim Americans, Jewish Americans.
Absolutely. And we'll see if there's a cohesive message from the Democrats. In terms of how things are shaping up right now, let's just repeat the headline that crossed a few minutes ago. Howard Lutnick, the Commerce Secretary, said President Trump is considering giving relief to countries that currently live under the U.S., Mexico, Canada trade pact rules. In other words, those tariffs that were imposed on Canada and Mexico may be rolled back or may be moderated. It's not clear exactly what that relief might look like. In terms of futures, we have seen Dow futures move up. NASDAQ futures were also a bit higher. At least they moved in that upward direction. Yeah,
and just to be clear for the viewers, what you're looking at basically is the price action off of the close here. So effectively, you are seeing futures, even though you see red on the screen, that's effectively an increase from where we were at the closing levels here.
Yeah.
We closed at 57.78 on the S&P, 58.26 here. So that is an encouraging sign heading into tomorrow. But of course, we still got the president's speech tonight.
Yeah, anything could happen, and who knows what he tends to go off script as well. So he could throw in a couple of extra lines. It's interesting that Greg Valliere thinks he's going to address food inflation because that's something that he hasn't really talked about. He campaigned on it and campaigned very effectively on it. But when he got into office, he addressed tariffs first before anything else. Yeah,
well, he addressed DEI and a lot of things that actually had no real impact on anyone's bottom line. But the fact of the matter is, I mean, I go to the grocery store every week, as I'm sure you do, and I see the pain. And and we're people of means, and you can only imagine the people not of means, how they're feeling right now.
All right, this is the close on Bloomberg. The Pentagon pushing back against reports that Defense Secretary Pete Hegseth ordered a halt in offensive cyber operations against Russia. Hegseth has yet to cancel or delay operations, but there also aren't any orders to stand down. Reports about the halt did make the rounds on Friday ahead of that turbulent Oval Office clash between President Trump and Ukraine's Volodymyr Zelensky. Joining us now for more on this is Dr. Hugh Thompson. He is executive chairman of RSAC. It is one of the leading platforms for advancing cybersecurity. Hugh, thank you for joining us. Now that the Pentagon has denied these reports, how significant would it have been if this did happen, or if the defense secretary was thinking about halting these offensive cyber operations against Russia?
Scarlett, first, thanks so much for having me. And it's actually pretty profound if this turns out to be the case. First, why do we have these operations in place? They're a deterrent. So the other side knows that we understand how to manipulate their infrastructure. We know where their weak points, especially in critical infrastructure, are. And it also serves as a critical reconnaissance gathering mechanism. So it's a very, very significant announcement if it ends up to be the case, although it's being denied, as you said, right now.
Okay, so that's something that, we'll wait to see how that develops. But I'm curious on your take in terms of what the U.S. is doing when it comes to ensuring that we're doing everything we can when it comes to cybersecurity against China.
And this is a tricky one. I'd say for a very, very long time, we've had significant capabilities in the U.S. to be able to inspect the infrastructure in China, to understand sort of where their key vulnerabilities are, where their key weaknesses are, again, as a deterrent, much like Russia. But we've also spent a lot of time looking for vulnerabilities in commonly used software that would be used in the case of an offensive operation. So I think with China, things are very tricky right now. Obviously, you've got tariffs being added and compounded, which could escalate things. And I think there's never been a more important time to invest in the cybersecurity resources, looking at these other nation states.
Are people doing that, though? And by people, I mean corporations, and for that matter, the government itself. I mean, we talk about, I don't want to get too deep into some of the changes that have been made over the last month or so in our U.S. government that certainly raises questions about how prepared we are. But we've seen some of the hacks already. We know they're there. Now, of course, with the layer of AI and the research going on in that space here, I mean, I feel like there's so many back doors that have either been opened or closed. It's hard to even know who's getting into what and where.
Yeah, Romain, you nailed it. Right, the number of attacks that we've seen. I think about Salt Typhoon, for example, where we've seen attacks against the telcos, and we've gotten guidance that says, well, geez, maybe you shouldn't trust the contents that you're getting in a text message, or maybe that information is now in the hands of another nation, in this case, China. We've seen a lot of capabilities on the side of these other nations, in particular China. What is the U.S. government doing about it? I think right now it's a little bit unclear. Things are in flux. A lot of the old leadership in cybersecurity has left or has been exited. You've got some new folks coming in. How quickly can they get up to speed? What is the strategy? What's the level of investment? These are open questions right now that the community is asking and they want answers to.
Well, talk to me about your community. I mean, the big conference that you guys put on, I know we're still a couple of months away from that. I think it's in late April or whenever this year. But what is that conversation going to be like? Because I have to imagine this year's conference is probably going to take a little bit of a different tone than what we would have seen 12 months ago.
You're exactly right. I mean, first of all, it's dominated, as you would expect, by AI. So agentic AI is number one with a bullet on the list of what's on the minds of people. And think about this as this AI, these LLMs, actually having agency, hence the word agentic, like they're actually allowed to do things on your behalf. If that starts happening, the underlying technology, who makes it? Has it been tampered with? Is there a nation state that's gotten a hold or could manipulate some of these foundation models that these AI agents depend on? Those are really, really big questions. And one of the ones that folks are going to be asking is, what is the current government plan around cyber defense? Who are the people that are leading it? And these are open questions. I think that's going to be a huge topic at this year's conference. We're expecting 45,000 people from around the world who represent cyber. That's what's on their mind.
So at the very least, I mean, there needs to be constant surveillance and monitoring. Elon Musk, we know, is busy slimming down the government. He's cutting a lot of fat, he says, but the risk is that he cuts into bone as well. What is your confidence that he does not compromise our ability to survey and monitor some of those things you just talked about?
You know, it's tough. You read the headlines, and we're in the middle of a movie, right? It's like you jumped in, you missed the first part, you're right in the middle. It's in a scene where a lot of people are exiting the building in cyber or getting laid off in cyber. But where does the movie end? I think what would be very helpful is to lay out what is the ideal end state that this administration has in mind. And it could be a great thing, and it could be a thing that the cyber community doesn't like. But it would be great to know, where do we end up?
Yeah.
That's a huge question.
Hugh, before we let you go, what's the biggest risk that keeps you up at night right now?
Oh, geez. So much is changing. You know, if you think about the amount of automation in your everyday life, I can't buy a refrigerator now that isn't a smart refrigerator. All of these kinetic devices are being connected at scale, and consumers want them. Hey, does this thing have AI? Great, let me get it. I don't know why I would use it, but I might want to use it in the future. With all of these interconnected devices, what are we doing strategically? What are we doing globally to make sure that they are protected and defended? And that's going to be, it's not just a U.S. effort, it's a worldwide effort. How are we going to work together with the rest of the world to make sure that society and our way of life sustains some critical vulnerabilities?
All right, Dr. Thompson, got to leave it there. Appreciate you taking the time for us. Hugh Thompson, Executive Chair over at the RSAC here. And a lot more coming up here in the next few hours that we have to keep our eye on. Scarlet Fu, and that includes a big speech by the President of the United States and a big speech by the President of China. This is Bloomberg. All right, some of China's biggest policy shifts are announced, of course, at one of its high-profile annual meetings of the National Parliament. That NPC meeting set to kick off in just a few hours' time out in China. Our very own Steve Engle is on the ground in Beijing. And Steve, let's talk about the policy proposals. Do we have any sense here as to what's going to be discussed?
Well, we do, of course, because the agenda for the National People's Congress, which does kick off today with the annual work report from the Premier Li Qiang at 9 o'clock in about 4 hours' time from now, essentially was laid out at the Central Economic Work Conference in December, behind closed doors, I might add. So then they take that to the National People's Congress, which is the annual session of Parliament. They debate it through, they get their marching orders, and follow through on those plans from the party. And that includes shoring up domestic demand, boosting the consumer, because keep in mind, against the backdrop of these tariffs and what they claim to be rising protectionism and unilateralism from the United States and others, they have to alter their business model, if you will. They've relied heavily on exports through the downturn in property, through the downturn and crackdown on the platform economy like Alibaba and the like. The consumer confidence is fairly low. They need to shift that calibration, if you will, to rely less on exports and to rely more on domestic consumption.
Yeah, that'll be the balance. And it's always been something that China has grappled with. Steve, I'm sure you heard that Howard Lutnick, the Commerce Secretary, said that the Trump administration could announce some relief on tariffs against Mexico and Canada. He didn't mention China, though. What is it about China where pretty much everyone expects the tariffs to stay and not be moderated in any way?
Well, one of the reasons from my first take on this, when I saw Lutnick's comments, is that China and the United States, while they've had back-channel talks, there has not been high-level talks between Xi and Trump since his inauguration. And they've not necessarily, from what we've understand, negotiated down any of these tariffs. And you saw just a couple of days ago when Donald Trump added another 10% on top of those February announced 10% tariffs. some frustration that there hadn't been any acknowledgement from the Chinese side that they are a participant in sending the precursors to fentanyl to places like Mexico that end up in the United States. And all messaging from state media so far, the last couple of weeks has been this is a U.S. domestic issue. This is a demand issue from the United States. This is not necessarily a China issue. And keep in mind, those 20% tariffs, 10 plus 10, are really in relation to the fentanyl issue. So that we haven't even crossed the bridge yet of the trade imbalance and the distortions of trade that could potentially go up as high as 60%, as threatened by Trump on the campaign trail.
All right, so you've got to leave it there. Seeing Engle out there in Beijing as we await the start of the National People's Congress meetings, Scarlett, out there in China. And it's kind of interesting because it's going to basically start around the same time that the U.S. president is addressing Congress here in Washington.
Yeah, but different audiences, right?
Well, maybe. I don't know. I mean, who are they talking to?
Well, they're talking to their own people because they're saying, you know what, that's a U.S. problem. And to what Steve was saying, Howard Lutnick was saying that when it comes to China, it's a drug war, not a trade war. That idea that they want action from Beijing on fentanyl and limiting access to that. But, when we come back to the United States, in addition to Trump's speech this evening, we're looking ahead to tomorrow's trade. We've got day 2 of Bloomberg Invest.
Day 2 of Bloomberg Invest tomorrow, and includes a lot of big names. I believe the former Treasury Secretary Steve Mnuchin is scheduled to make an appearance, as well as a few other illustrious figures.
Yeah, it'll be fascinating to get his take on this. He's already gone through Trade War 1. Trade War 2 looks a little bit different this time. And, of course, there's economic data coming up, including, the drumbeat of data heading to jobs.
Yeah, and we get that ISM services data. That could be critical.
Yes.
Remember, a big move in the market yesterday was the ISM manufacturing data. Manufacturing, of course, only 10% of the economy. So that services number and the price index could be a huge part of what moves the market tomorrow. We're also going to get some stuff here in New York out of the mayor. The Mayor Adams, the mayor of New York City, scheduled to show up for an immigration hearing down in Washington, and the Fed set to release its beige book.
Yes, the anecdotal survey of what different banks within the Federal Reserve System are telling them. And of course, we get more earnings, including from Victoria's Secret and Marvell.
Zscaler as well. Some interesting commentary out of this company earlier in the day, as everyone right now really focused in on the relationship between the U.S. and the rest of the world. Balance of Power will have more context on that, as well as their full coverage tonight of the President of the United States address to Congress.